Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, October 16th at about 1:30 p.m. Eastern. Well, U.S. retail sales accelerated in September, rounding out a strong quarter of economic activity. Sales jumped 1.9% last month as consumers bought motor vehicles and clothing, dined out, and splashed out on hobbies. And on that note, and a positive note it is, let's go on to 3 charts that could give us some insight into the week to come. First of all, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. Of course, this is the exchange traded fund that closely follows our benchmark S&P 500 index. Now, as you can see over here on the hard right edge of the chart, as we call it, the SPY gapped up today and then just kind of sat there all day long, pulled back a little bit. And I don't know if you can see it. I know it's small on your charts, but so far today, the SPY has just created a doji, which means it's pretty much where it opened right now. So it's trading right at the current moment, $349.04, or about $34.90 on the S&P 500 itself. Fortunately, the SPY is still trading above the green line, the 50-day simple moving average that you see here. We use the 50-day moving average because many institutional traders look at that as well. And when price of any asset is trading above a 50-day moving average, that's considered to be bullish. It's a medium-term trend. Of course, if price is trading below it, that's considered to be a little more bearish. So the 50-day moving average is important. If the big guys and gals who move the markets watch this line as a kind of a buy or sell signal, then we're going to watch it too. The red line is the 20-day simple moving average, and if you think of it this way, there's about 20 to 21 trading days in a month. So if you're looking at price and it's trading above the 20-day moving average, then it means it's more positive right now on a monthly basis kind of thing. And of course, it would be negative were it trading below it. Then we also have on this chart the black 200-day moving average, and that is also considered to be an important moving average in technical analysis. These are the 3 moving averages I keep on my screens, especially for looking at indexes, kind of with a 20-day being a short, the 50-day being a medium or intermediate, and the 200-day being a long kind of a term trading indicator. So that's how we use those. Now, again, as the SPY is trading above the 50-day line, which is coming in at $339.38, and the 20-day line is actually below it. It's become inverted below the 20-day because of the down move we saw in September. It's gradually moving up here, and it will be positive when and if the 20-day rises above the 50-day. That's always a nice little positive move when that happens. Now, as you probably remember, the SPY made a new all-time closing high on September 2nd at $357.70. That was fantastic. Then it moved down from there all the way down to about 320 and then rallied back up. So right at this moment in time, the SPY is trading at about 3% off of its all-time closing high back here in September. So considering everything that's going on, this index, our benchmark index, has stayed, except for the little dip here, it's stayed really positive. I'm impressed. I'm impressed. Now, nearby support again would be at the 50-day moving average at about 339. You could call it 340. Also down here a little lower down here by about 330 or so, and then we have it down here at 320 or 3200 on the S&P 500 itself. I drew this blue trend line in here so you could see I mean, earlier in the year, after it bounced off March, it made a pretty rapid move up, then consolidated here in the end of May and June, then made another rapid move up. But now after this move down, our trend line here pulls back into a little more shallow move. Right now, what we want to see, and I'll be gratified if it happens, but I'm not going to hold my breath right now. In order to keep this little uptrend going, we need the SPY to move up here and move back up above about 350 here to move up over this high. Otherwise, we may see it trade in a range here. As you know, in the coming week, we are wandering into the thickest part of earnings season. IBM is going to announce, Intel's going to announce, it'll be Netflix. I believe Netflix is going to announce next week. We've got about 3 weeks of very heavy earnings season. So if the SPY can stay above the 50-day moving average, as again, maybe it could trade in a range, or it'd be great if it moved back toward that all-time high. That would be fantastic. If it needs to rest a little bit, I suspect we're going to get a little volatility in here. Third quarter earnings season is usually volatile. So we will see what happens. Of course, we've also got the election coming up, and a whole lot going on in this country. So we will see how the stock market reacts in the coming week. Our next chart today is the Invesco QQQ. We show this as well because this follows the all-important index, the NASDAQ 100, major index in the market. And of course, the holdings that propel this are the large cap momentum stocks and tech leaders. They're getting hit a little bit today because of the government crawling all over them, but still in all, the leaders here are Apple, Amazon, Alphabet, Facebook, so forth. So when I captured this chart today, the QQQ was trading at $291.21. It touched a new all-time closing high back here on September 2nd at $302.76. That moved up dramatically. You can look down here, see the RSI at that point moved up over the 70 line, meaning it was overbought. Usually when it gets up over the 70 line, you're going to see a pullback or a retracement pretty soon as it gets overbought and people start taking profits, and that's exactly what happened. It slid all the way down here to 260, to 260 in September, then rallied back up here, and again right now trading at 291.25, and that's about 4% below this all-time high back here. Now it has managed to rally up above the 50-day moving average. I don't know if you remember this, but last week we talked about how this could almost be or is a continuation pattern that is doing the formation of an inverse head and shoulders. That can be positive. It can suggest that price will continue higher from here, but of course we are in kind of a crazy world right now, so we never can count on the market to do what we think it's going to do. And right now, it will be interesting to see if the QQQ can stay above the 50-day moving average, which is coming in at 279.56 right now. You can see here the 20-day is moving up over the 50-day, as we talked about on the past chart. It is doing that. And so it's coming in also at 279, just a few cents away from the 50-day moving average. So they're moving right here into a juxtaposition. That's all good. The next support down here, so it will be at, from where the QQQ is right now, the next support will be at the 50-day moving average. Then we can move on down here. Well, we got the 50-day, then we can move on down here and say our next support line here. Potential support is at 260 again, down at the bottom of this inverse, potentially head and shoulders. If the QQQ can keep going in the coming week, if earnings turn out to be fantastic for the tech stocks, who knows, that may well could happen. The QQQ could potentially move back up to this all-time high at 302, 303 right here. But remember, to remain bullish, the QQQ has to at least stay over this 50-day moving average. So it'd be great if we could see momentum stocks meet or beat earnings estimates and come in with really strong forward guidance that could help the market stay a bit positive here. Okay, now let's look into our final chart today is the iShares US Pharmaceutical ETF, the IHE. I couldn't resist today considering what's going on in the market with the announcements about some of the pharma stocks. This IHE has 47 holdings. Some of the top holdings are Johnson & Johnson, Merck, Catalent, Myocardia, and Pfizer. Pfizer, of course, is the star today. Now, when I captured this chart today, the IHE was trading at $169.90. It has jumped, it fell down back in the middle of September here, then all of a sudden gapped open and popped up over the 50-day moving average. Now I think pharmaceutical stocks should have a little bit of an edge going here into the future considering everything that's going on. Please know that they also do not always move in sync with the market. Pharmaceutical stocks, biotech stocks, they kind of go their own direction depending on the clinical trials and what's going on. So it can be a little independent of the broader market, which I like right at this moment in time. Now, the all-time high, closing high for the IHE, you can't see it on this screen. It was in July of 2015 at $184.63. So about 5 years ago, and certainly up higher. If we look down here to the left side of the chart, we see that the IHE touched its March lows at $115.53. Then, of course, it rallied, made a nice V-shaped recovery here, moved up to about 160 in May and June, fell with the market, but rallied back up quickly, and it's pretty much walked up its 50-day moving average very, very nicely for the past few months, except for the drop down here that most of the market experienced in September. It's rallied up again quickly. So again, I'm looking at it now at $169.90. If the IHE can remain positive in the coming week and above its 50-day moving average, which now comes in at $165.08. So just remember 165. If it does so and it still looks positive, I may add a position of the IHE to my portfolio. I will place my initial stop at $164.50. Now, I want it to stay above the 50-day moving average. As long as it does that, I'm a happy camper, okay? Because I think pharmaceuticals could go higher from here. However, I have that's my fingers crossed part, but I don't trade like that. I trade with a hard stop in, a hard stop meaning a stop placed with my broker. So the plan is if I add shares to my portfolio, I will place my initial stop at $164.50, right below the 50-day moving average. When or if the IHE can break above here 173, I will probably add shares to my portfolio. And by then, of course, my stop will be a trailing stop. So you may want to keep an eye on the IHE during the coming week. And now, before we go on to final thoughts, please know that if you'd like to become a more successful trader, this is the perfect time to check out my trading programs. You will discover my simple yet powerful strategies devoted to swing trading, trend trading, bottom fishing, and much more that will help you increase your gains quickly and easily. To see all of my programs, go to the link on this screen right here, or simply check on the orange button below. And now, for final thoughts, here's our question for the week. When the market becomes reactive, do I also become emotional and reactive? When the market becomes reactive, do I also become emotional and reactive? When I trade, do I mirror the market's action and become reactive, or do I wait for the market to move and then respond? Hear the difference here. There's react and there's respond. Do I wait for the market to move and then respond to that move according to my plan? So right now, with the election, with third quarter earnings season upon us, with coronavirus questions on the horizon, we can probably guess accurately that we'll see more volatility come into the market in coming weeks. Now, as traders, I don't know about you, but most of us tend to mirror the market's action, meaning if the market becomes more emotionally reactive, racing higher and sliding lower, then our approach to the market tends to adapt those emotions as well. It's just human nature. We look at this up, down, all over the place, and we go, oh my gosh, and we start reacting to that. Now, the way to come out on top and make money in this scenario is to make sure, and you've heard this 1,000 times and it's always right, make sure you are planning your trade and trading your plan. If you have a plan in place, if the market throws you a curve, you can respond to that change with confidence. If, on the other hand, you have no plan in place, no stop in mind, no risk, no plan for your risk, you can make decisions that will end up creating a loss, and no doubt a bigger loss than you might have sustained with your plan in place. Please know that this market is going to be run by and react to headlines. So now is not a time in the market when we can guess what's going to happen next and be sure about it. Now is not a time when we can afford to trade using our emotions. Now is not a time when we can bank on opinions from talking heads. Please remember, no one on earth knows which way this market is going next. No one. So cherry pick your trades, plan them thoughtfully before you enter, consider if it gets volatile trading small share size, and please know when to stand on the sidelines. Remember, cash is a position. This is the time to plan and respond, to be deliberate and confident, and certainly not reactive, okay? Deliberate and confident. Your trading account will thank you. Finally, if you want to become a consistently winning trader, check out our easy-to-learn yet powerful online training programs that will help you increase your trading profits from now on. From swing trading to bottom fishing to trend trading and more, just click on the button below for more information. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.